Welcome, everybody. Les Williams, that's me. I am the head of partnerships for Sunny Day Fund, also an investor in the company. I feel so strongly about workplace emergency savings and financial wellness that this prompted me to really help lead the charge and spread financial wellness and also emergency savings, that gospel, to the masses. Before I introduce my amazing guests, I kind of want to set the stage of what's going on here. So we'll start with a slide presentation. My colleague, Brittany, is going to be going through a slide deck. She's going to share her screen. So for those who do not know, Sunny Day Fund, we have a mission, a very strong mission, enabling all employees to achieve financial stability and freedom, starting with workplace emergency savings. For those who are not familiar with workplace emergency savings, we all know 401k plan, right? They've been around, I guess, since the 80s, right? And now it's very commonplace. In fact, pretty much a requirement these days if you're a large employer or even mid-size to have some type of 401k retirement plan for your employees. What we here at Sunny Day Fund feel is that workplace emergency savings, and sometimes it's abbreviated ESAs, those will be as ubiquitous and commonplace as 401ks. And because of Secure Act 2.0, which was passed December 30th of 2022 by Biden, when that was signed into law, it kind of sparked a lot of interest in workplace emergency savings. So it kind of sets the stage for what we do and why we are here. The next slide is going to detail, and I'll wait, there it goes. Yeah. So total debt balance and its composition. So this is from the New York Fed Consumer Credit Panel slash Equifax. Mortgages remain the lion's share of overall debt. It's about $12 trillion currently, as you can see if you're looking to the far right, that yellow bar. But auto loans, student loans, and credit debt is rising really fast. If we just take a look, the total debt right there is in second quarter of 2023, $17 trillion total. We see that red bar, that's student loans, that is slowly growing. And we're probably going to, of course, see that even grow even more in the coming months and years. So really scary stuff that's going on for our economy. Now, this is what's interesting. The New York Fed is seeing auto loans, credit card, mortgage delinquencies rise again. Now, student loan delinquencies have been muted, but that's probably going to follow suit later this year and into next year, just for the mere fact that the unpausing of student loans is coming again October 1st. And how to read this graph, just to make it simple. If you guys look at, let's take credit card debt and let's look at first quarter of 2009. You see that's about 14%. That means credit card borrowers, about 14% of credit card debt was delinquent. That's how you read that. So as you can see, student loans had a precipitous drop off the past 2 or 3 years just because, things were on pause. We do expect that to rise, unfortunately, pretty significantly, and delinquencies to go back up. We will touch on the article from the Wall Street Journal later on during this discussion. And finally, the last slide, short-term debt, like credit card and auto loans, they're negatively correlated with self-reported financial well-being. Kind of makes sense. It's intuitive, right? The more debt you have, as you can see, if we're reading the x-axis there, is you're going to the right. The more debt you have, the more unhappy you're going to be from a financial wellness standpoint. Now, conversely, um, financial well-being is directly correlated with savings. You've done the work at Sunny Day Fund. The more savings you have, or the plan you have for savings, you will feel more secure from a financial well-being standpoint. Now we'll go to the next slide as I introduce you to these dynamic panelists we're going to have. My good friend Andy Manthai, he's with Green Path Financial Wellness. They're a partner of Sunny Day Fund, and they work with us to offer financial wellness planning to our clients, the employees, and they're very, very helpful. And so thank you so much, Andy. You can raise your hand there so people can see you. So can't wait to talk to you in a little bit. And of course, our good friend from Pittsburgh, we have Detroit and Pittsburgh with us today. Next slide is my good friend Kevin Bove. And Kevin is with HB Retirement based out of Pittsburgh. You see the lovely cityscape behind him. So thank you so much for joining us. We're also partners with HB Retirement, and their group has been very active in terms of introducing workplace emergency savings to their clients. So thank you so much for having us, Kevin. And then last but not least, you got me, Les. Of course, I introduced myself earlier. Sunny Day Fund, Director of Partnerships. So good to see you guys. I want to start with Andy first. Can you tell us the work you're doing at GreenPath, Andy, and what are some of the debt trends you've been seeing in 2023?
Absolutely, Les, and thanks for having me here as well. It's been a pretty interesting year, I guess I would say, when you really start looking at it. So GreenPath, we've been around for 62 years. We do financial counseling and education. One of our core products is a debt management plan, which allows people to reduce their interest rates on credit cards, especially. It can be a lifeline for folks that maybe think bankruptcy is their only option, but with those reduced interest rates, they can actually pay off their debt. And so that can sometimes be a good fit for folks. But we also handle all of the housing counseling. We do credit report reviews. We do everything from home buyer readiness to anything to do with foreclosure prevention and things like that. So very tuned into what's going on with the debt. And what we've seen year over year, just with the people that we're serving, and we talk to over 100,000 people a year, is from July to July, from 2022 to 2023, we actually saw the average amount of debt go from 9,000 to almost 15,000 from the people that we talked to. And the median amount of debt went from it was about 4,300 to a little over 7,000, pushing close to 8,000 as a median. On top of that, one of the things that we noticed from a cash flow crunch was that 53% of the people we talked to were within $100 of a budget deficit, which means that, an extra $100 puts them in the red on a given month, which means relying on credit cards and other forms of debt. What we expect with the student loan situation is that that number is going to increase by another 50%, because we do see, based on the data, that 1 in 4 people are going to add a payment of about $500 a month. And so we're really trying to help people navigate this. We know inflation's been an issue for the past 2, 3 years. And we know that all of the stimulus that people had received we've seen this big spike where people's savings had gone up. We saw financial health improve through the financial health network and all of those aspects. And then as inflation started to really take off with all of the global events, as well as the local events and supply chain and all of those different things, all of a sudden the savings started to go down and the credit cards just skyrocketed. And seeing that figure jump up over 1 trillion, we just are expecting that we're going to be even busier. And we're actually in the process of hiring 20 more counselors to handle the volumes that we are seeing as well. And it's one of those situations where we're just kind of batting down the hatches right now and helping people the best that we can, helping them navigate, trying to focus on the overall cash flow. What can they do to start saving? Are there behavioral nudges that they can do? Letting them know that they're not alone, that it's going to be okay. One of the different things that we talk to the people that call GreenPath is telling everybody you are not alone. So many people start to feel isolated and depressed and stressed, and we want to alleviate some of that. And we let them know it's going to be okay. So I think as we really start digging into even deeper trends, we're going to see big time impacts also on when we're talking about marginalized communities, underserved communities, Black, Indigenous, people of color. We knew already that there were issues with wealth gaps. We already knew there were issues with the amount of student debt, the levels of mortgages, the home ownership piece, all of those things. And it's being exacerbated even further now. And so we're really trying to focus on how can we create new products and services that meet some of these needs. So focusing on finding ways that we might be able to, instead of necessarily tackling the credit cards, what about all those payday loans and medical bills and cash advances and all of the things that are typically holding other people down, that may not have traditional access to a lot of the normal banking services as well. So there's a lot to cover there, Les. And as we kind of work through a lot of these different pieces, every person that we're talking to is at least formulating a plan. And from that perspective, when we start talking about the savings piece, many people feel like it's a pet pipe dream, that it's just the American dream is the American nightmare. And they're saying, how can I possibly save? So what we focus on then are things like automation. If it's a behavioral situation where you're only focused on what you currently have coming into the account, as opposed to a situation where, you're actively trying to set aside money, there's other things that can hinder that. So a set it and forget it situation can help, and in actually dedicating money to go towards the things that you need them to. So
That's powerful. Thank you, Andy, and that's a great opening opus. And I have a question for you. You see me taking copious notes. And I have a question from the audience as well. So the first question is, I know you said in your work you've seen the average debt go from $9,000 to $15,000. Can you talk to us about the breakdown of what that debt is? And what spurred me to ask that question, and approximately, is that one graph I showed where you saw the mortgages, you saw the credit card debts, auto loans, and on top of that, this dovetails nicely into a question that Mike asked directly to me on the chat. From a medical bill perspective, because that's something that I didn't outline in that graph, what part does that take up? That component, what percentage approximately? And are you also advising clients to say, hey, of all the things you can be a little bit late on, are medical bills, because I think by law it cannot accumulate interest. So can you touch on that breakdown and then dive a little bit into the medical bill portion before we go over to Kevin?
yeah, that's a good clarification. And I should make sure that I state the figures I gave you were specifically credit cards.
Okay,
So
gotcha,
we did not dig into additional, I didn't pull more data
gotcha.
around those other pieces. The student loans have been a really interesting thing because they've been dormant for so long.
Yeah,
As far as the medical debts, when we really take a look at the advice that we give people, we want people to be whole. We want them to pay everything. Sometimes, though, it's a situation where we advise them to communicate more with their doctors, with the hospitals. There's so many aspects of the medical system that people are unaware of, and many of the hospitals are nonprofits. There are there are levels of income that many of the debt can be written off, can be forgiven. There's foundational money that could be used to cover those things. And so we tell them to focus on the things that they have to have, and that's your shelter, that's your car. If you need to get to work, that's how you are going to be able to pay the bills. And then we start to filter through from there. We also talk about, it may not be the best idea to put medical bills on credit cards, because now you're turning that into a different type of debt. And the recourse that comes from a charged off credit card is very different than a charged off medical bills, because as you mentioned, when there were new rules that were put into place, and the impact on the credit score of medical bills significantly reduced, and in many cases eliminated as well. So yeah, when you start to kind of look through what some of those impacts would look like, what I will say is there was another piece of debt, as far as the student loans. Last year in 2022, about 33% of people that contacted us had student loans. This year it's 35%. And of those, one of the really interesting pieces, Les, are, we know student loans in general, about 7 to 8% are private loans. People contacting us with student loan questions, it's about 20% have private loans, because the federal has other options. They've
yeah,
got some things, they've got some new plans even that are coming out. Private is a very different beast, and it's a very different thing when you take a look at all of that as well.
definitely.
So
Yeah,
did that
can't wait
answer
to.
what you were looking for?
It
And
did. No, it
okay.
100% did. Yeah. Thank you for that. Thank you also for clarifying that. I got a few more direct messages saying, "Oh, I thought the 9 to 15,000 was overall debt," but that's just credit card, not
It's
to mention
just
any
credit
other credit
cards.
card. So that's, oh, we're gonna dive into that a little bit more. Thank you so much. And now we'll go from Detroit to Pittsburgh. Kevin, so good to see you again. As senior financial advisor at HB Retirement, what are some of the changes workers are making in their financial planning, just given the current environment of these rising interest rates and these other things that Andy and I just spoke about?
Thanks, Les. Thanks so much for having me to you and Sunny Day. Look forward to this conversation. I think it's a great question. I think more than anything, I would respond. Workers are asking questions now.
Mhm.
Myself and our team of financial advisors, maybe a little less contact with as many people as Andy and his group, but we're doing thousands of meetings per year where we're one-on-one in front of the person or in a Zoom meeting just like this. And what I'd say is that people are really feeling the effect of the inflation, and they're having to consider other things, such as Can I continue saving for long-term, such as 401k, the same way? Do I need to rework what my budget looks like? If I would have an emergency and I need to take on debt, such as something that happens to the car or the roof, how would I do that? So it's really providing some opportunities for us to partner with people and to have conversations where kind of the advice or the counseling is very different now than it was a year ago. So I think it's a great time to be having this conversation.
Absolutely, and thank you so much for that. Are you finding too, because one of the things that I know, like my wife and I, we have 529 plans set aside, mainly for our god kids, right? Are you finding when we start talking about student loan debt, are you finding more people have been asking about 529 plans just to say, oh God, I don't want to make sure, I want to make sure my child or friends of mine don't go through the same things that I have to go through with my debt currently. Is that something that a trend you're seeing?
I'm not sure that it would be directly tied to student loan debt, but I think that
Yeah,
there has been a recurring trend of more and more people asking about 529s, probably for the reason you just said. They
yeah,
have family members or friends or grandparents are trying to get involved. So more Americans are turning to 529s and trying to get educated about it because of the rising costs of education, of it being a necessary component. And you mentioned 401k plans starting in the 80s. 529s are certainly well behind, lagging when they started. And just as how 401k plans have become so normal part of our life. And I say 401k, I guess I should say employer sponsored retirement plans, 403b or 457 being ones as well. But I think 529s over time will just be that ingrained, and it won't be just some people do it. It'll be more common in our culture and in our financial lives, especially as over the last few years, the expansion of what a 529 can be used for.
yes.
Private school, or it just feels that the direction will be that we can continue to use those for more and more reasons, so that less debt is taken on by Americans.
Yeah, absolutely. Thank you so much,
Sure.
Kevin. And along those same lines of the credit card debt that we talked about earlier, and this is separate even in the Wall Street Journal article that I referenced at the beginning of this webinar. But this summer was the first time that we hit $1 trillion in credit card debt, consumer credit card debt. And I believe it happened around July. And I know the team at Sunny Day Fund, and I know I spoke to your team at GreenPath about this, Andy. And I know your team at HP has been all over this too, Kevin. Andy, how's your team advising workers on how to tackle this credit card debt? Can you talk about some creative anecdotes about how people are addressing this? Because this is historic, and unfortunately, based on that graph I showed earlier, it's probably only going to get worse.
Yeah. Well, the first thing that we typically really try to focus in on is what's going on in the person's life. What are they trying to accomplish? What are their goals? And then trying to figure out what behavioral pieces are going to make the most sense. And what I mean by that is when we start to evaluate all of the different debt pieces, when we start to be stressed, our cognitive abilities go down.
Mhm.
And we don't make as wise of decisions as we might if we had all of the information presented before us. And so, if we can get people just take a step back, take a breath, connect with them, get outside of their fight or flight and their defensive mechanisms and start getting into their creativity and their problem solving, that's where the you're not alone and it's going to be okay comes in, as well as just our overall communication. And what we do from there is really try to unpack what kinds of debt do you have? What are the things that motivate you to tackle this debt? And then what are the options? And the reason that I bring that up is because when we talk about things like the snowball or avalanche method, many people just don't have a plan. They're just making their minimum payments. They're just trying to survive. They're trying to get their kids to practice and school and all of the things. And sometimes you have to get that stuff down on paper. You've got to figure out, okay, how much debt do I actually have? How much are my minimum payments? How long would this take me to pay off if I just make my minimum payments? Once we kind of establish that baseline, then we start looking at what kind of flexibility do we have within our budget. So if we take a look at, okay, I do have some wiggle room here for about an extra $150. Now, what motivates you? Is it checking the box and getting small wins? Then a snowball method might work, because if you start getting those smaller amount debts down first, get them off there, and then start taking that payment, apply it to the next one. And then once you get that second one paid off, take both those payments and apply it to the next one. But some people are really adamant about this company's not getting all my money and my interest. So an avalanche method might make more sense, and talk to them about looking at stacking them according to the interest rates. So I'm really going to throw any extra cash that I have, whether it's my tax return or anything else, I'm going to hit those higher those higher interest rates and bring those back down. And so those are the two primary methods. Now, some people, their interest rates are so high, their budget is so tight that it might not fit. So then we might talk about debt management, and the average goes from about 22% in the interest rate to about 6%. And so by using some of those same techniques, we can get them paid off in less than 5 years. Not a fit for everybody, but it can be a lifesaver and sometimes affect the cash flow because their minimum payments might be $500 on a debt management plan because of the concessions that the creditors would have. It might be $300. So now you've got an extra $200 that you could start putting towards other aspects, your retirement, your emergency savings, and things like that. So it gives that breathing room. And sometimes it's just so tight that we just say, okay, well, what are some of the other options you've considered? Here are some of the things, the pros and cons. Does it make sense to talk to an attorney? We would never give legal advice and tell somebody to file bankruptcy, but we've got to at least have that conversation if they're in a significant budget deficit and they just can't make enough from there. Sometimes people say, no, I'm absolutely not going to do that. So we talk about income. We partner with a fellow organization in Financial Health Network called Steady that has a lot of gig work and side jobs that people can make an average of about $400 extra a month. That maybe that gets them out of debt, because if you can get that debt paid off, all those minimum payments now become built into the cash flow that you can now reallocate. You can now get into your retirement plans and your emergency funds and all of the other things that maybe got you into some credit cards to begin with. Start looking at a sub-share account for a vacation account, so you're not financing Walt Disney World and those types of decisions as well. So it really comes down to the individual conversation, but those are generally the paths that we will walk people through and empower them to make the decision. What's going to make the most sense based on your family and your decisions?
This dovetails perfectly. Jennifer Smith has a question she just sent me, and it allows me to bring up this other Wall Street Journal article that I referenced at the start of the webinar. And it was major news. If you guys go on the Wall Street Journal digital, you can see it. Just type in student loan repayment and it'll pop up. And it talks about a family. And they each of them have $200 a month that they're paying towards their student loan. So a household of 3 people, young child, and they live in Oswego, New York. And they literally were detailing to the day what they were doing to take on this additional payment. He's not going to buy any more coffee every day. It's about $3.50 that he buys every day. So I was doing the math in my head, right? How much is that per month? They were actually going to buy cheaper store brand products. So it itemized what they're doing to offset that. Now, retailers are really concerned about this because there was some free cash that folks had the past 3 years where they could spend on other things, right? i.e., TVs or maybe some luxuries that they otherwise wouldn't do. But now that that is going away, Andy, Jennifer asks, great points you laid out. How is your advice going to change given October 1st coming up?
Well, I mean, it in a lot of ways, it does it. I mean, we talk about something called the latte effect. And so many people, when you start to look at budgeting pieces, people are like, cut out the coffee. But
Yeah.
my personal story is I was counseling somebody one day and I said, okay, well, let's take a look at this. And he's like, Andy, I've cut out my cable. I've cut out my internet. He went through the whole laundry list. He's like, this is the only thing that makes me feel like a human being and makes me like actually have hope in the day that I can just enjoy my pumpkin spice latte or whatever, we're coming up on October.
Yeah.
And so the point being is that each person has to align their priorities. And we do have a workbook that's available on our website that talks about the priority piece, because when you look at those student loans, what a lot of people do is they get that in the mail and they freak out and they say, oh, I guess that's what I have to pay. But what if they're on a standard repayment plan and they could qualify for public service loan forgiveness and one of the new SAVE plans? They could potentially have a 0% payment, or if they have a low payment and it doesn't cover all the interest under the new SAVE plan, they can actually not have the additional interest. So let's say their payment was $50 or $40, but it was $50 in interest. Only the $40 goes towards interest. The additional 10 does not count and does not add back into your balance. So you don't have this negative amortization. So as we take a look at all of these different options, you have to know what's available. And with all of the income driven repayment plans and the pay as you earn and all of those other aspects, we want to make sure that people are actively speaking with their servicer to evaluate what programs they qualify for and that they know how this would impact them. I was recently doing another article interview, and there was a teacher who was expressing specific concerns about the SAVE plan. They didn't think it might be a good idea. But here's the thing. If you have a very seasonal type of work, or your income fluctuates, or there's other aspects that can really impact your ability to pay, keep that payment lower. Find the lower payment and then add more as you can. Make sure you establish some nest egg. Make sure you have some emergency savings. Don't automatically sign up for the higher payment. It could make sense for you if your goal is, I want to get this knocked out in 5 years, but keeping that monthly obligation higher, it's like even refinancing a mortgage. What some people do there is, they'll tack on to a 30-year because I can save $300-400 a month, but my interest rate was only the difference of 0.05. Well, if you kept your original interest rate, you'd save all that extra money from the refinancing and put that onto the principal and start working towards paying that down. You're paying less interest. So again, it's strategies. It's really thinking through your individual situation, your overall priorities. And I apologize for the long-winded answer.
No, this is great. This is the passion. It's great. I really appreciate that. And Jennifer does too. She sent me a note back and said thanks. So excellent, excellent. And I'm going to stay on that same theme. We were talking about the credit card debt at $1 trillion. I'll pass things back to Kevin. So we have credit card debt at $1 trillion. Student debt is a couple trillion, as we saw again that graph that I showed earlier, the second slide. Mortgages make up close to $12 trillion, and of course they're not getting any cheaper. My dad and I were joking the other day, 7% mortgage rate, that's a steal these days. So Kevin, can you talk to us about some of the strategies that some of your clients are looking at when they're looking to finance purchases? What type of actions are they taking in this higher interest rate environment?
Yeah, thanks, Les. It's a good question. As I mentioned in the last point, the answer or the solution is different now, and projects are still going to need done. Repairs are still going to be needed. Americans are going to have to access savings or take on debt for normal life activities. And now that rate is 7, 8, 9% and not 3, what should we be doing? And anytime you do have a conversation in a group like this, it's always a bit worrisome to give a specific example, but just wanted to provide one. And that's, basically I was having a conversation 2 weeks ago with someone that works at one of our retirement plans, and we were talking about some debt they were going to have to take on, and having them do a home equity line of credit with a non-fixed rate of 7% just didn't feel like the right option. I and certainly our team at HP Retirement, we are helping people all the time, and usually is, how do we save more into a 401k plan? Well, this particular conversation had to turn to, they had access to the money within a loan within their 401k. Now, certainly this is not advice to everyone, go run to your 401k and take the money out and do a loan, but because of the inflation environment, because of the interest rate environment, and to a lot of the points that Andy was making, an individual decision, an individual conversation needs to be had with people to evaluate the full landscape of tools that are available. It's not the run to the bank, take the low interest loan, don't worry, the interest rate's not going to change on it. It has to be, what are my other options now? And certainly we never want to tell people to delay things that have to be done, but the pro-con analysis now to take on debt is certainly a lot worse than it was 18 months ago. So those are the conversations that we're having and have to have, so that people can make the best financial decisions that they can.
And that's so important. Sarah Hughes actually just sent a note and said, wow, that's really impressive that Kevin mentioned take in this situation, take a loan out of your 401k. The reason being is because so many times we hear, don't touch your 401k at all costs. But in this unique environment, sometimes, like I said, it may make sense to do it again, as long as you have a plan and how are you going to repay it back. So that's interesting. And thank you,
And
Sarah, for that.
in this example, it is the better of two bad options.
Yeah,
It is
yeah.
not a good option, but
It's
it's
kind of
the
good.
better
Exactly.
of two bad
Two
options,
bad
and that
options.
is important.
Yes, yes. Can you talk a little bit too? I'm going to stay on this topic, auto loans. So I joke, and full disclosure, my financial advisors were on this call too. So I was joking with them. I said, I'm nervous now because I hope everything I'm saying, you guys are gonna. I'm reporting back to you guys next week during our monthly calls. But I have a 20-year-old car, runs great, 138,000 miles, Ford Explorer. My friend just got a new car, and he put quite a bit down, and he's paying about $340 a month. He lives in North Carolina, and when he was done doing that, it was just a Cadillac, right? It was a used Cadillac. The woman closed her laptop, took her glasses off, and said, "I have not seen this low of a monthly interest payment in 15 years." And my friend said, "What do you mean?" She says, "The average like monthly payment is close to $900 or almost $1,000 for a car." And I was shocked. We just had this conversation last week when he got it, and I again, I've been out of the game for 20 years. I've had the same used car, so I don't know much about. I don't keep track of. I feel like that political candidate when they say, "Hey, do you know how much milk costs?" and they stumble, "Oh, I don't." You're not a man of the people, right? So I do not understand how these cars. Can you talk to us about what you're advising people? Just forget even the student loans for a second, but on auto loan. I can't believe how much cars cost these days, and it kind of it sent me into a tailspin. So
Yeah, I think it's a great question, and auto loans and really looking at the type of debt you're bringing on auto loans in particular. I think it's really easy to make the decision of the kind of car that you want,
yeah,
and not necessarily that the car that's practical for you and your family. And as you were describing that, I was thinking your financial advisors are very lucky to have a client that has a 20-year-old car, makes some other decisions much easier. But I think the important part is auto debt, student loan debt, making sure that it fits your life and making sure that you have a plan as to repay it. Um, for student loan debts, making sure that when you're taking on it, that there's a plan for how I'm going to pay it off after with whatever degree I'm studying for. And just as I don't want to tell people don't go buy X car, perhaps you can accomplish the same thing with another car at a lower rate. And to the example your friend must have had, they must have done a nice job of putting money down to get a low payment. So it's part of that overall picture. I think it's a little bit of keeping up with the Joneses. People want to have that same car that their friend or neighbor has, but really, I think they'll be better off in the long run looking what fits into their overall lifestyle.
gotcha. Thank you so much. And Patrick Wild, I saw your comment too. And this goes back. I want to make sure I address that. And to Andy, he says so many people don't understand where all the hidden fees, subscription, and interest and penalties exist in their monthly spending. So it goes back to what you were saying, Andy, about yes, you could refinance, but instead of doing that, there's costs to that. So whenever somebody hears the word refinance, we think, oh yes, you should do it, lower rates, but what are the costs of doing that? So I'm glad Patrick brought that up because on a case by case basis, that's really important. And Rachel says we have a 300,000 miles on our 2007 Tacoma. We have so much in common, Les. Yes, we do. Yes, we do. Yeah. So I'm such a big fan of just keeping a car as long as I can. It's the second car I've had. The first was a old used Isuzu Rodeo, and I drove it until the seat started coming apart, and it wasn't safe anymore. So that's so there's a balance. If we go back to the topic of mortgage rates for a second, and thank you, Andy, for tackling that question for me. Um, uh, Andy, can you talk to us also about the work you're doing? You mentioned earlier the Opportunity Resource Fund, and we had spoken in the past about community builders. You mentioned BIPOC, and for those on the call, BIPOC stands for Black, Indigenous, People of Color, BIPOC, and women. Can you talk about how you're helping BIPOC and women get to the path of home ownership? I thought that was very interesting.
Yeah, so we're in trying to evaluate what people's actual goals are. We are entrenched in the community and we're trying very hard to spend some time in conversation to understand what people need. And one of the projects that we're working on is a racial economic equity incubator. And we're working with a credit union in in Michigan called Michigan State University, FCU. And basically through that program, we've been connected with an organization called Community Builders that got they're actually nationwide, but they recently got a big HUD grant, and there's a big area in Detroit called Corktown, and there's a lot of gentrification going on there. Affordability of housing is very limited, and so what we're trying to do is incorporate some financial education combined with a company and an organization called Opportunity Resource Fund and their Justice Fund initiative. Now, in this particular housing, people are currently paying rent, and they are women-led households. And what they're looking to do is move into home ownership. And so as a CDFI, Community Development Financial Institution, what Opportunity Resource Fund is looking to do is, after the education, look to get a mortgage into an affordable home, and then eventually bring this person along to a more traditional mortgage product, something that they may be outside currently with some of the different credit ramifications or credit requirements that they might have. And so we're looking to build these blocks. So for instance, what we often find is people that are mired in poor credit have had issues with payday loans and their access to more prime opportunities for credit. And they don't have those types of things. And then they hold out because when they try to get a more prime product to pay off that other stuff, they're denied. So they don't have any other recourse except for this. And so we're trying to break that with some different loan products that would really focus on the payday lenders and the collections debts and all those derogatory items to really help boost credit as well. So it's a multi-pronged approach. There's a lot of different nuanced pieces in play there, but the overall goal is we can get them into an affordable mortgage rate. We can get them into an affordable home instead of paying 2 and 3% higher than most other people, because that's where the subprime market lives. We don't want that for folks. So we want to get them into a prime situation.
And a fantastic organization and cause. Are you trying to replicate this to other cities, or are there other, similar type of initiatives going on in Chicago, DC, Dallas?
We're hoping to be able to scale this. So we're still in pilot phase and discovery phase and things like that. Some of the issues we're running into, Les, is, in Detroit, we had 2 foreclosure crises. We had in the early 2000s and 2008. There are a lot of people that have gone through the financial trauma of foreclosure. And we had one woman who said, I know I should from a wealth perspective, but it's so expensive for the furnace and all these other added pieces of stress. But they're told they should own a home, but that might
Yeah,
not be the best fit. And so, we're trying to figure out, how do we get people equal opportunity? How do we get people equity in the access to all the products that exist out there?
absolutely. Thank you so much. And Kevin, before I get to you, thank you, Rita. Everybody can see this in the chat. Refinancing is really just starting over a new mortgage. And many times you're going from a 30-year to another 30-year, and you're extending your term, which means longer time in debt. So
Yeah.
the focus is, how do you pay off the mortgage early and be free and have a free and clear asset, which you'll have more disposable income when you retire, and of course build an emergency fund and max retirement contributions. Rita, you're exactly right. On the surface level, especially when interest rates go back down, knock on wood one day, oh, let's refinance again. But you're right. Are you doing it in a way that's smart and not just, switching another 30-year for another 30-year and just extending it out even further, then living off of that extra cash you're not paying towards your mortgage on other goodies and other items. So you're exactly right. Very, very great thought there. Thank you so much for that, Rita. And Kevin, we'll go back to you. You're the finance guy. Well, first of all, Andy, thank you for the work you're doing. I think that's fantastic and really powerful stuff. Kevin, you're the finance guy. So in the course of helping, what you do for a living every day, helping people build wealth over time, debt sometimes can still feel overwhelming. In this environment, is saving unrealistic? And what type of role does saving play at all in this debt mess that we've been talking about for the past 43 minutes?
Yeah, thanks for asking the question that way. I think it's a good conversation. I think joining into a webinar like this, and Les, your role, Andy's role, my role is to talk about the problems of right now. But there's always going to be some level of problem. There's always going to be something going on in the market don't allow the negativity of what's going on right now, the inflation and interest rates, deter you from building wealth and saving for retirement or paying off debt. Is about making the best decisions you can over and over and over again. And having that repetition is really the way that whatever your financial plan gets better. So, yes, there are things that we need to be concerned about right now: high interest rates, how do we access debt? But that doesn't mean that we need to stop those core activities. I referenced earlier that the American worker is potentially looking to reduce their retirement plan contribution. I understand that. People need to make the decisions for the here and now in the situation. But I would really urge that person, don't stop that retirement contribution. Reduce it. Don't stop it, because keeping that regular activity by human nature allows us to go back to it, rather it be months, years, decade before they do it again. So there is still hope. There absolutely, we will get through this segment there, but there will be something else on the horizon, which is why having a plan, and the nice thing about a financial plan is almost everything that you enact can be redone and reworked. In will need to all the time. I'll joke with clients all the time upon their retirement. Yes, we've spent months or years working on your budget. I'm fairly comfortable saying a quarter from now, we're going to tear it up and start again because your life's different. That's the same with every financial plan. And be prepared for that and be flexible and know that all you can do is make the best plan that you can in that moment with the foresight of what you think's coming. And then you deal with things as they come along. But the saving towards any goal can still happen, actually has to keep happening regardless of market for goals to be able to be achieved.
It's so interesting you mentioned that, Kevin. Oh, go right ahead, Andy. Go right ahead.
I just want to yes and Kevin also from a perspective that, people oftentimes they think, oh, I'm just going to drop this. But if it's pre-tax, they should talk to their HR and figure out what is that actual net change. Because if on a pre-tax basis, they might be trying to save $50, but the difference is maybe 15 because they're in a lower tax bracket. And, it's like differences like that to evaluate. Most people just look straight out the gate that we have to do this. We run into this with medical premiums all the time too. People will choose the cheaper plan, even though it's not the best fit for their family, because that's just the number they see, but they don't look at that after tax actual cash flow. So I love that point, Kevin. That was awesome.
No, it's fantastic. And habits is a big thing. So, and this is something for many people on this webinar, the attendees, you'll hear us at Sunny Day Fund say this is when you set aside money on a bi-monthly period, most folks are paid bi-monthly, 15th of the month, at the end of the month. Even if we even say, look, even if it's $5, right? Do that. Just start somewhere to get in the habit. Because when you start getting raises, when other things come into play and new money, you can then up it. But if you're not in the habit of setting that money aside, then you kind of lose that. So getting exactly what you said, Kevin, is making sure you're in the habit of saving something. And the inverse is true. All of us, or many of us on this call, we get asked for donations from your alumni association, whatever school you went to. So what popped in my head as you were talking, Kevin, is my wife and I, we always give money to both UVA and Harvard Business School. We specifically check the box to, we want this to go to certain students, right? That, pay it forward type of thing. And so when I graduated, I was the head fundraiser for my class in business school. What they told me is they said, the key is participation. We don't care how much it is. If it's $10, do that. And I said, why? And they said, the reason why is as salaries go up over time, you'll be in the habit of giving money. So then more money you can give towards certain scholarships for students that are coming after you. So developing habits are really important. So that's in emergency saving, the same thing. Whatever you can save, save. Same thing for retirement. Whatever you can save for retirement, even if it's a little bit, you got to get in that habit. And it's a turtle game, right? Over time, we're not racing to just get the most savings we can get within a month, but over time develop those habits. We're running a little bit closer to time, and so what I wanted to do, it's been fascinating. We can go on for hours about this, but I want to kind of get closing thoughts from both of you. So knowing our audience of employers and employees, if they've asked excellent questions, what advice would you offer them for the future of managing debt and planning for savings? Kind of closing thoughts. We'll start with you, Andy, and then we'll end with you, Kevin.
Sure. So the first thing I would speak to the employers is listen to the employees. Don't paint with a broad brush. One of our most active employers, we actually did some design work with their ERGs or their BRGs. Some organizations look at it because there may be different needs. When we looked at conversations that we had with the Black ERG versus the LGBTQ plus, there's different needs that are surfacing. And so really trying to evaluate all of the different offerings from a benefit perspective, including a lot of people have gotten into student loan repayment. What if people don't have student loans? Could you offer a unsecured debt repayment benefit? So, there are different aspects of thinking through how to serve. But listen, really have some deep conversations from a place of curiosity. And I think that's really going to help as you look at the benefits. And on a personal level, for anybody that's out there that's dealing with debt, because it's not just low income earners. We know that about a third of people who make six figures also carry credit card debt. And you're not alone. It's going to be okay. And have hope and grace. Have hope that you can get it paid down, and give yourself grace when it doesn't work right. I think that's one of the biggest things that I've always tried to share is people can get so mired in shame and frustration when it didn't work how it was planned. Just hop back up. It's okay. Like things don't always work right. You just can't give up. You can't throw the baby out with the bathwater. That's probably a terrible thing to say now, but I mean, you can't just like say I'm done with it because I'm fully giving up. It's like, all right, that particular thing didn't work or that day didn't work, but I'm gonna go back at it. So hope and grace, and listen to your employees.
Thank you so much, Andy. Awesome words. Awesome words. Kevin.
Yeah. So I think my last message would be we're in this together. Whether it's the employees, the employers, us as industry professionals, we're in this together in thinking about ways to tackle whatever the economic situation is. Now it's interest rates and debt, but whatever the situation is, you take a look at what options are there to employers to couple on what Andy said. You listen to what your employees are telling you, and know that there are options outside of the standard benefits. Yes, our group, we are 401k or retirement plan experts, but that doesn't mean that every solution can be solved with us and solved with the products we typically use. One of the reasons for our partnership with Sunny Day is because some of the things that need solved for the American worker today can't really be effectively done through the retirement plan. And for employees, I guess my challenge to you would be make sure that you're voicing what you need. But second, make sure that you're understanding what is actually offered by your employer. From the meetings I do, it's amazing how often we'll find that there is a benefit that is already in place that you can utilize. So, and then the final thing is be comfortable coming to groups like Green Path or groups like Henderson Brothers that are present and available. And sometimes just having a person to talk through your situation helps you lead you down the right path because you're verbalizing it or writing down a plan. So certainly, hopefully I can speak for Andy. We're here to help and want to address all of these things. And to Sunny Day and Les, thanks for having us for this good conversation.
Oh, absolutely, guys. You guys are great. And we'll go to we have a last slide. This is the slide of everybody's contact information. And many of you, I always save time for questions, but all the questions literally came up during the discussion, which is what I love. Jennifer, Sarah, Patrick, Rita. There were some more folks that participated. Thank you so much on here. Take a screenshot of this. If you have any questions at all, reach out to any one of us at all. We're here to help. And these two gentlemen, Kevin and Andy, fantastic job. Your closing thoughts are basically mine. Let's see. Patrick has one question though. Let me see if I can get to this in my Zoom here. Let's see here. Look at this. Patrick's, or sorry, this is Mr. McAllister. Now that we are in open enrollment season, employees should spend some serious time evaluating their healthcare options rather than just picking the cheapest deduction from their paycheck with a higher deductible, which they may not be able to afford and cause more financial strain in the long run. So that's actually a comment. You're right on. You're exactly right. And in fact, that's something that I think, Andy, you set that on, as you mentioned that as well. We always tend to go to that cheaper, cheaper, cheaper versus if we take a step back, look and see in the long run over that year period that you're going to have that health plan, what's going to be the most effective to you. So you're exactly right. Thank you so much for that. I didn't get your first name. It's just R. McAllister. So thank you. You could be a Mrs. So my apologies if I missed you on that. But thank you. And you had the final word, McAllister, on that one. Giving everybody back 6 minutes into their day. Contact us if you have any questions at all. Thanks to Kevin and Andy and my team at Sunny Day Fund for having this. And as we say at Sunny Day Fund, have a sunny day. Thank you so much, guys.
Thank you so much, Les, and the Sunny Day team.
Have a great day, everyone.